We've just published our latest investment outlook, our Q2 investment outlook, and what I want to do now is just quickly run through our latest views on how markets are going to play out over the next 6 to 12 months. Well, the world looks very different from certainly what it did all of 3 months ago. We are now staring at a substantial global recession, and we're starting to see this show up in the economic data. Global business confidence collapsed in April. As you can see here, it fell way below the lows which it fell to in the global financial crisis. And if we look at the UK, the decline in GDP, we could see in the second quarter, estimates range from around 15% to as much as 25% decline in GDP. And that would leave GDP or economic activity down around 13% for the year as a whole, which would actually amount to the most serious recession since the 1700s. So on the back of this, as it were, deep recession we're now facing, the 30% decline in equity markets we saw back in February isn't too surprising. Arguably what's more surprising is that from their lows on the 23rd of March, actually markets have now bounced back around 25%, and they've regained some half of their losses, as you can see here. And essentially the reason why this is happening is twofold. The first is that there has been a massive monetary and fiscal stimulus implemented. And we've got the numbers for the fiscal stimulus here. For the developed world, it amounts to around 12% of GDP. It's been particularly big in the US. And not only this, but we've also got unprecedented monetary stimulus also being put in at the same time. Interest rates have been slashed, and quantitative easing programs have been restarted. And quantitative easing implies a direct injection of liquidity into the markets, and that's certainly one of the reasons why markets have been able to rebound so quickly. The second reason, though, is that the market is hoping very much that this massive fiscal and monetary stimulus, which is as unparalleled as indeed the global recession is unprecedented, that this will trigger a sharp recovery in the economies, or to quote the usual phrase people use, a V-shaped recovery. We're not entirely convinced that this is going to happen. Actually, in terms of letters of the alphabet, rather more of the view that the recovery will be U-shaped rather than V-shaped, so it will be a shallower affair. You are going to see high rates of growth in the second half of this year, no doubt, but this comes against the backdrop of the very sharp decline we've seen in the second quarter. And it's definitely true that this monetary and fiscal stimulus will limit what would otherwise be very severe damage to the economies. But at the end of the day, how this all plays out is clearly going to depend on how fast and how sustainably these lockdowns are being relaxed. As you can see here, the lockdowns are being relaxed now, but it's fairly gradual. Obviously, this is very much going to depend on how the virus plays out, or to be more accurate, what happens to the R value, which we all now know about, and whether we get a secondary spike of infections. In terms of getting a full recovery, as the Federal Reserve Chairman last week only said, you're very much going to need a vaccine. There's a faint chance you could see one this year, but most people seem to think that in terms of getting a vaccine, getting it tested, and getting it rolled out to millions of billions of people, then that is going to be a case of middle of next year at the earliest. And only when you get that are you going to get a full recovery in the economy. In the meantime, you're still going to have social distancing, you're still going to have people worrying about getting infected, and this is clearly going to affect confidence. So we're not as convinced as the market that actually it's going to be a V-shaped recovery. The other slightly concerning thing at the moment is if you look at equity valuations. Back at the low point in March, they were definitely cheap. they're no longer definitely cheap. In fact, valuations are now back slightly above their long-term average. Even if you use, for this comparison, these are price earnings ratios, even if you use a somewhat optimistic consensus earnings forecast for 2 years' time, when hopefully the bulk of the rebound should have happened. So essentially, we think the markets have come too far too fast, and that is why actually we raised a bit of cash a few weeks ago. And essentially, our game plan, if you want to, for want of a better word, is to reinvest this cash once we see markets fall back somewhat. Today, actually, markets are up another 2 or 3%, having fallen back a bit last week, but we do think this is somewhat overdone. And actually, there is a new sort of source or grounds for a bit of caution which has emerged in the last week or so, and that is the escalation of tensions between the US and China. And if you remember back to 2018, the big reason for the big sell-off back then was exactly this, the fear of a trade war, and certainly the US has taken new actions against China, and there's once again a risk that this tension could spiral out of control. So we think there are grounds for caution short term, but it has to be said, on a sort of 1 or 2 year view, there's every reason to think that equity markets should rebound further. And if you just look at the chart here, which shows you the scale of the rebound you've seen typically after significant bear markets, you'll see that after 6 months, equities have typically gained 30% or so. At the moment, after a little more than a month, we're up 25. So a lot of the gains this time, I think, have been sort of happened in a very short space of time. But on 1 year view, you're looking at gains of 35 to 40%. So our base case is very much that, sure, markets may fall back a bit near term, which we raised some cash to take advantage of, but certainly on a 1 year view, 2 year view, markets have got room to rise significantly further. In terms of our positioning within equity markets, we have turned more cautious on the UK. The UK market has actually started to underperform again, and this is for the very simple reason that we are now staring at a deep recession, whereas prior to COVID, we were obviously looking at a pickup in the UK economy on the back of a sizable fiscal boost. Now instead, we're looking at a significant recession. Also, we've got Brexit, the cliffhanger re-emerging once again. The latest talks with the EU didn't really go anywhere. And once again, we're wondering whether we'll be facing a no-deal Brexit at the end of the year. So all these factors are undermining UK risk assets at the moment. UK equities are underperforming again, and we have turned somewhat more cautious on this. And also the pound has fallen back. So UK more cautious than before. US, actually, we are more optimistic than before, just because the election poses less of a risk than it did. Now we've got Joe Biden as a Democratic candidate, and also two sectors which we do like at the moment, technology and healthcare. They form particularly large weights in the US market. Another area we remain positive on is emerging markets in Asia. Asia is clearly rebounding out of this crisis faster than the developed world, and valuations remain a long-term attraction. And then finally, we retain significant thematic allocations within our equity holdings. This has been a focus for us for some time, certainly in this sort of low growth world we now are in going forward. We think you've really got to focus on these secular themes. And these, we think, include things like technology. All the forces behind technology have just been reinforced by what's going on in the last few months. And also environmental change is another area that we're positive on. So anyway, those are our views at the moment, and I will give you another update in a week's time with our standard weekly broadcast. Thank you.